We've been talking all morning so far about this losing streak for stocks, down for the month. How much do you attribute that to seasonality? How much is that attributed to higher rates?
Yeah, Frank, I always think it's a combination, but the higher rate environment is putting pressure on stocks and bonds, right? And it's not just the month, which has been tough for capital markets. Actually, if you step back and look at the S&P price level, it's where it was in April of 2021. So 2.5 years ago. This is a difficult part of the cycle because we're a little bit late cycle. The economic growth level is certainly slowing. And as you mentioned, the Fed has increased rates quite a bit.
All right, so you said the economic cycle is slowing down, but I want to talk to you about earnings season. We're just about halfway through. Looking at FactSet, they say we're on track for our first year-over-year gain when it comes to earnings since Q3 of 2022, so essentially a year ago. At the same time, we have some big market voices. I'm talking Morgan Stanley's Mike Wilson, JP Morgan's Kalanovic. They're saying the forward estimates are too high. Is that important for investors right now, or should we just enjoy the earnings gains that we're seeing?
Well, I think investors are answering that question with their response to earnings, and we're actually seeing stocks down generally on earnings, and that's unusual. So the market's always going to be a discounting mechanism, and when the management teams of these companies, project more challenging times ahead, I think the stock market is taking note of that, and investors should as well. It's a good time to be active and be thinking about what sectors and companies you want to own at this part of the cycle, because I don't think you want to broadly own the stock market right here.
Just in all fairness, though, it's kind of a reversal for Mike Wilson. So he started the year bearish, then he came back and kind of gave a mea culpa. Then just 2 weeks ago, he said he thought there'd be a year-end rally. Obviously, some things have changed, but in your mind, does the idea of a year-end rally, is it very unlikely at this point?
Well, we could get it. I mean, year-end rally now, Frank, we're talking about just 2 more months. So that's a difficult time horizon to be predicting equity returns. Candidly, we will let Cloud Capital think about investments over cycles and thinking about a little bit of a longer time horizon when we do our fundamental research. But look, it's fair to acknowledge for strategists and investors, this is a really difficult time in the capital market cycle, right? We're late stage. The Fed's just had that dramatic move. Everybody's trying to grapple with quantitative tightening now. So, if we can assume that QE and quantitative easing and lower rates were really stimulative on the way up, it's only fair to assume that we're going to have some restrictive response in equities when quantitative tightening sets in. And I think that's what we're seeing right now.
All right, of course, today is day 1 of the Fed meeting. Tomorrow is going to get the decision. What are your thoughts about the Fed right now? Do you believe we're going to see a pause? And if we see a pause, is it a hawkish pause or is it a dovish pause?
Well, it sounds like we're going to get a pause, Frank. But yes, everything will be, a lot of people will be focusing on the body language and the narrative around that. And, I think at Cloud Capital, look, in the near term, our view is that rates are about where the Fed wants them, right? We're more or less calibrating, and they're going to monitor the data. What might get really interesting if things begin to kind of break in the capital markets and we get more sell-offs and some of the credit delinquencies and we're seeing that consumers are really using a lot of the financing that's available to them. I think it'll be interesting to see kind of a couple of quarters from now how quickly the Fed might have to reverse course, because we still have a dynamic where there's a lot of debt on the U.S. balance sheet, and boomers are retiring. That tends to be a deflationary force. We've got a lot of technology which is being kind of implemented and integrated throughout the capital markets and the economy, and that tends to be a deflationary force. So it could be a surprise that kind of a year from now we see the Fed having to reverse course because the effects of their tightening path have kind of borne itself out on the economy. And we're already seeing that in consumer durables and some of the
something we'll have to watch, Vince.
All right, it's something to watch for sure.